Time now for the finale, the last session of RESi360, and hopefully some of you at least will have submitted questions. We've been badgering you to do so over the entire course of the conference. This session is called Where Does the Future Lie? Which is an easy one to answer, isn't it? It lies in the future. But fortunately, we've come up with a few more difficult poses than that one for our panel. We're going to talk to the money, ladies and gentlemen, to the bankers and the investors. Let me introduce you now, if they'd like to come up. We've got Jason Constable, Shamez, Alibhai, Ben Sanderson, and Owain Thomas. Come and grab a chair. Right, hello. Let's do the Scylla thing again, shall we? It's much easier for me, and you probably know the answer far better than I do. So let's just go round the group. Who are you and where do you come from?
Hi there, I'm Jason Constable, and I'm head of real estate for the UK corporate bank at Barclays, looking after about 800 clients across the SME spectrum, all the way through to the national house builders.
How much money is that?
About £10 billion.
10 billion. Okay, let's see who can get the most. Let's go and kick that.
Afternoon, Ben Sanderson. I run the real estate group at Aviva Investors, and Aviva Investors is part of the real assets group, which has 50 billion AUM.
50 billion. Is that by the same measure?
We're going up.
Okay, all right, fine. So you're winning. Yeah.
See where this is going.
Hi, my name is Shamez, Alibhai, Managing Director at Man Group. We're 160 billion. And I manage the community housing strategy, which is really about delivering affordability, environmental sustainability, and communities in the UK.
And finally.
Hi, I'm Owain Thomas. I'm the MD of the investment and development business of Cortland in the UK or Europe. So Cortland is an American multifamily owner, operator, developer in the US. We have about 85,000 units in the US. And now we're building a platform over here in the UK. I'm not going to.
How many billion?
Help me out, Eric.
I started at the wrong end. Yeah. $17 billion AUM in the US.
Right. So we've talked a lot during the course of the last couple of days about what investors want, particularly around ESG. And I thought, well, let's start with even just the last sessions we've been having. We've been thinking about the E, certainly. Shamez, do you want to sort of start us off really on the importance for you of having the right sort of green wraparound in terms of the investments you're going to make, and particularly thinking about zero carbon and where we are on that journey? So
we are a socially responsible investor, so we have no choice about how much green we put in. We have to put as much green in to the solution as we can. If you look at the UK's journey to zero carbon, we've done really well as a nation. We've reduced our carbon footprint faster than almost any country in the OECD 20. That's a fabulous outcome. We've been terrible when it comes to housing.
Really?
Our housing carbon footprint is largely unchanged in the last 20 years. And we've seen it recently with the spike in energy costs, households complaining about energy bills, etc. That's the old building stock that we have not taken time to refurbish. So I think when it comes to carbon footprint, if we're going to take the next step of the UK's journey, we have to think about housing and housing's role in lowering the carbon footprint. And we're starting to experiment, so we're doing a development right now in the South Coast, in Saltdean. That development will be about 65% on average lower carbon than building regs requires us to do. And we're going to have about 25% of those homes as completely zero carbon homes. Now, it's a step, it's a small step, but unless we start moving now, we're not going to be able to meet our aspirational targets of zero carbon by 2030.
Sure. So in terms of, perhaps I can ask you, in terms of the way that an investor is thinking about where they're going to put their money, I mean, we know that ESG is important. What is your message to those who might be knocking at your door in terms of what they need to provide to demonstrate that they're in the right place on this?
Yes, I mean, obviously, I'm a lender of money, and I think in common with some of the themes that have come out this morning, we're getting increasingly asked by our SME and private developer client base that, they have a demand to actually supply more sustainable housing because, you know, we saw a lot of the data points yesterday all point to that demand driver. But they just haven't got the support or access to green lending product. And I know colleagues at Lloyds have talked about it this morning. And, you know, as a mainstream lender, we're keen to play our part in that and therefore to help drive the agenda. By happy coincidence, Mark, we are today launching our sustainable residential development framework. And that's something we worked up in collaboration with the environmental consultancy team at CBRE, but it's very much focused on not only facilitating clients in that space, but also actively incentivising them to build more projects.
Let's talk about the incentivising bit. So we know that the stuff's coming, the legislation is coming down the track. We know that buildings are going to have to reach certain standards by certain dates, and it's going to get tougher as we go on, and maybe that we don't always hit them, but that's certainly the ambition, and there may be some legislation to make sure that it does happen. As a lender, presumably you are increasingly going to need to be confident that these developments are future-proof in terms of the environmental standards that may be coming down the track.
Absolutely, which is why we spent the best part of 12 months really being careful about how we set up this framework to make sure that it does future-proof. It's, you know, we don't want to be seen to be doing anything that could be accused of greenwashing or anything like that. It needs to withstand independent verification. But I think to that point, solving the new build piece in relative terms is probably easier than, to your point, around the current built environment and the whole transition financing challenge that we have. You know, a number of our clients have legacy estates they've owned for, you know, multiple generations, and that is no small task to try and deal with that.
Ben, just thinking on sort of more investment side, we've said this, we know that ESG is increasingly important to many of the institutional investors. What's the advice for the room in terms of their thinking of because there's obviously costs attached with how far down you go, how quickly you go in terms of the offer. What's your advice?
Yeah, I mean, it's a non-negotiable feature of our attitude, and the reason for it is because we take a very clear view that you will deliver better long-run risk-adjusted returns by doing that. And so the point about regulation, which could, for example, mean that some of your buildings you can't be let in commercial and residential space in the future. And even if those regulations change, there's a clear groundswell from occupiers. We heard in the previous session, for example, about the...
In terms of save money, actually, probably more than the planet, but yeah, both can.
The great phrase earlier, one of the guys on the previous panel said about going green to pay less. And if you think about your end value, you think about your sustainability from the sense of the tenant retention, things like that, assets that are greener or have better ESG credentials more broadly will deliver better returns. It's a risk factor for a lender, for example, and it's a return factor for someone like us who's mainly an equity investor. And so it's a massively significant. So it's about delivering better returns, and that's the clear message that we're hearing from our clients, and we're acting on that when we invest.
Oh, and I've got a question which I think you discussed when you met before the conference, which was how does investor green look versus developer green, and what challenges does that bring? I rather suspect that there is a difference between investor green and developer green.
I think you can almost add operation into that phase. You think of the life cycle of any building, you know, green credentials, how do you carry that through? Development phase is very, very important, but you know, a large chunk of these buildings are in occupation. I think the trouble that we have, and most people in this room, is that we're quite segmented in, you know, developer role, operator role, funding role. I think we on the funding side, whether it's, you know, debt or equity space, we've got an onus to make sure that we mandate the right controls. I think even in the last 12 months, we've seen developers starting to be more discerning in making sure that when they're, you know, getting planning consent for new buildings and designing them, that they're actually fit for this audience who's looking to invest in those assets. I think also for us, you know, echoing that point earlier with Ben, is that when we look at two buildings, and one is substantially greener than the other, the investment is fundamentally easier to invest in, not only for the now, but if we're also selling those two assets in 5-10 years.
Yeah.
the most desirable product will be the greener product as things start to evolve. And
there'll be a temptation, you know, for a development company board to think, well, we don't want to go too fast too soon because there's big costs and, you know, there's lots of economic headwinds and so on. So what's your advice if they're sitting around that table thinking, you know, well, how future-proof do we want to be? You know, it's a difficult one.
It's really tough. I think for most developers, there's no gold standard of what sustainable looks like.
Yeah.
You know, what does ESG mean for this person versus the next? So I think where we need to really evolve to, and maybe this is a funder-led discussion, in that, you know, we need to reach out to our development partners and actually say, hey, this is what sustainable looks like.
Yeah.
So I suspect most people in this room don't really understand what sustainable is and how to implement it in any kind of design.
Yeah, I mean, just the difference between zero carbon, carbon neutral, actually what that means in real terms of how you operate.
It's confusing.
Yeah, you were nodding. Yes, on that.
It is, but frankly, it's your job. Let's be candid about this, right? I mean, we heard a long discussion about tenant experience, for example, and the operational challenges of running a BTR portfolio. And that's true in any new sector, any real estate investment market, that you have to acknowledge that first generation will be different to second generation, and the generations all go through quickly. From the point of view of thinking purely about ESG and developing in a way that makes it future-proof, it's your job to see through the valley and make sure you're delivering assets with high sustainable characteristics, with high social value, and with a good governance framework around it. That's our jobs. Yeah. So saying it's hard isn't frankly good enough. You must actually acknowledge that this is your job to do, because your investors will demand it, and ultimately the residential tenants will demand it too. So it is a challenge, but you've got to...
Yeah, that's what you're paid for, mate. Get on with it. Yeah, fine. A question come in, which leads me neatly into what I want to talk about next anyway. There's a lot of talk about investing in new build stock, but what's your investment appetite today in existing housing stock, which makes up the vast majority we know? So this goes back to, I suppose, the point we were making, Shamez, earlier about sort of retrofitting or making existing stock fit for purpose. And I'm wondering about that dynamic of demolishing and rebuilding, which in some ways makes life a lot simpler, especially if you're dealing with poor quality stock, versus the embodied carbon question, which it's all in there. As soon as you knock it down, you're going to have to, well, you have to work out, you have to measure actually what the cost of the new build's going to be, and whether that starts to change the thinking about retrofitting versus new build. What's your feeling about where the market's going to go?
So we've taken a perspective which is, I think there's no one answer for England. So I think it depends on where you're looking to invest in England. So we've taken the perspective that in areas of the country where there's a lot of economic activity, the real issue is the supply of housing. There's just not enough housing stock that's being delivered, and not enough housing stock at an affordable level. I'm just call it a small A affordable level, right? So if you're a teacher in Cambridge, where are you going to live? If you're a nurse in Brighton, where are you going to stay?
Go to Oxford, mate. It's impossible. It's just ridiculous.
And so for us, our focus has been around this question of additionality. How do you build new affordable homes that are environmentally sustainable?
You can densify, though, can't you? You don't have to go and...
You don't have to, and I think from, there's parts of the country, if you start going outside of that, you know, if you start going to some parts of the Northeast and the Northwest, there's been such underinvestment in housing stock that there the real issue is, how do you bring that housing stock up to standards? You know, the EPC ratings are not uniformly distributed across the country. They tend to be lower quality EPC homes as you go farther north. And so I think there's a different answer to that. We've been thinking about this, how do you invest in existing stock and bringing up the environmental footprint, improving it? It's hard. It's a hard problem to solve.
So, Jason, I'm just interested in this argument about, you know, new build versus regenerate, retrofit. You know. I think it feels to me as though we're still in the foothills, actually, of working out how we do this, how we recycle material from buildings that we're going to substantially regenerate. I mean, there are people who are in that space, but it seems to me as though that part of the sector's really got a lot of development to do.
It has, quite honestly. We have conversations with clients which can be very sophisticated, and they've got great plans in place, to the other end of the spectrum where it's, what does ESG stand for, right? And they've got And it's almost an element of denial because the sheer scale of the challenge that they've got. And, you know, if you think about sort of large sort of family offices and so on, where there's, as I say, as I mentioned earlier, you know, there may be real estate that's been in that family for, you know, 50, 60 years, right? And it's kind of, they're at a tipping point, you know, what's the right thing? Do I bring it up to scratch, or do I actually then take the view that
some of it is really rubbish. Well,
absolutely,
you know.
but the issue is you can't just leave it there as an obsolete building, because that's still not going to solve.
No, that doesn't get you anywhere. We need more houses apart from anything else.
Exactly.
So we are going to have to develop. And do you think is this an area where you think perhaps the sector should be thinking more proactively about how we're going to deal? We want to get down to zero. Actually, it doesn't make any sense at all to knock down an existing building, put it all in a hole in the ground, and import a whole load of new stuff. You know, that is just not going to work.
I think architecturally, you look at London, you've houses that have been retail units, houses again, apartments. I mean, we should be building for the long term, which we don't often do. I think we develop quite poorly. But I think also legislation is really going to help drive what we do in this space. I think someone shared a staggering fact with me yesterday. It was that 64% of Manchester city centres residential stock, so PRS and non-BTR stock, is an EPC D or below. And in a few years' time, those owners, those PRS landlords, will not be able to let those units to private landlords.
And a lot of them are going to be caught out by that, aren't
Absolutely.
they?
That's staggering.
Especially the smaller ones.
Yeah. So in terms of the investment required to bring up that stock across Manchester, but the UK, be staggering.
And I also think, you know, I look at my own house. I live in an early Victorian house. It's hellishly drafty. Yeah. It costs a fortune to replace. I'm not sure I really want to either. Beautiful old, you know, windows with some great triple. But I probably am going to. There's probably going to be a point, perhaps not that far away, where legislation is you literally can't sell your house unless it hits certain standards.
And you've got to challenge it. So this issue is a couple of dimensions to it. One is the technical aspect, and one is the financial aspect to it. And then you've got also the social consequences of the transition to low carbon homes. So for new homes, embodied carbon legislation, I think, is relatively, you know, it's going to come along relatively soon.
Yeah.
A change of government would almost certainly deliver that, and that would change the dynamics for new build investors in terms of having to address the issues of embodied carbon in a more material way, and that may well make financially more lucrative and make the numbers stack up to convert rather than build new if you legislate against embodied carbon. But the broader issue, I think, for a lot of owners of this is that, you know, the economics of converting the housing stock in the UK, and you talked before, didn't you, about how the carbon footprint of housing has not really changed. The challenge there is that the social consequences of that are really, really significant, because people are sitting in homes that won't meet legislation, that won't meet the low carbon guidelines and the net zero ambitions of the country, and frankly, you know, are not fit for purpose in a net zero context. Who's going to finance that? Yeah. So the bottom line is it's a market failure which needs addressing, because you can't lend to it, I can't invest in it, so it needs to be addressed in the same way we heard earlier, Homes England working in partnership with capital to address a market failure to regenerate. There's a role for government or a government agency to address that market failure, to work with the capital here to address that, because it's really almost impossible to imagine the scale of this problem of retrofitting being solved purely by the capital on the stage.
I think there's just a failure in government. There's a failure in policy, and until that failure in policy is addressed, there's really nothing we can do, right? We have to wait to figure out which direction is this looking. And the problem with the government policy is it's been very short-termist. 1 year, 2 years, somebody else comes in. We've had how many housing ministers? We're on number 12 now?
I could almost tell you. There was an extra one I haven't counted, but I think it's 13 in the last 12 years.
Okay,
you know,
so you know, until we have housing being taken seriously and this issue being taken seriously, it makes it very difficult for all four of us, despite the billions we have, to apply.
It would be nice to get clarity. I'm certainly not going to get it anytime soon, because, well, certainly not in the next 2 years, because we've got a new government, and you know they're not going to want to, they're going to have the time, frankly, to sort that out. There's the one question that I've been given, which was actually written down. which actually is relevant to exactly this point. Can you fund joint ventures to allow councils/housing associations to work with private developers to repurpose existing commercial property so net zero 2050 is a real possibility? I'm going to broaden the question slightly into actually the way in which funders can help create the partnerships that are going to make stuff possible. You're nodding.
Yeah, I think we heard a little bit of this earlier from the English Cities Partnership, for example, with L&G working with Muse the developer and Homes England. That's a unique structure they've got, but not a unique concept. That idea of taking institutional long-term capital to work alongside local authorities to help regenerate, either in that example of the question, converting office stock, say, to housing or building new housing, but also increasingly thinking about ways you can be the one-stop shop to deliver the private, the student, the senior living, the affordable parts all in one piece, as well as the working element to do with office or retail or leisure as well. That is the dream, and that's one of the reasons why, you heard it from L&G before, but we're in the same boat. Aviva Investors, we're trying to bring together our infrastructure team, our real estate equity team, our real estate debt team together to try and provide those sort of solutions to work with local authorities, because without that sort of capital together, with different costs of capital, you're not going to solve those problems. And that's the vision, that's the dream. And the good news is, I think, a lot of local authorities, people in the room will know this, are very commercially minded, wanting to work with private capital and want to work in a meaningful and long-term way, which I think is great for the future. But it doesn't happen overnight. No. 20 years, the English Cities Fund, for example, that's the timescale these things can take.
I don't want to leave the green sustainability agenda, but I want us perhaps just to focus on another thing that I know we've been talking about a lot in the last day and a half, and will be uppermost in many people's minds, which is the current economic climate, and actually what's coming down the track, and the impact that's going to have on different parts of the residential sector. So on later living, on specialist products, student products, at BTR, as we've been talking about. Do you want to start us off, Jason?
That's an easy one.
Well, broad thoughts at the moment, I think.
So no, I think, look, it'd be remiss of me not to say that, a lot of our developer clients in particular are nervous about inflationary pressure, and obviously now compound that with increased interest rates and, further speculation that those are probably going to go higher than we originally anticipated. But I think certainly our house view from an economics perspective is that there's hope, and I think it's hope, that the actual benefit on inflation from from Liz's initial energy price cap piece that she announced recently, we think is actually going to have quite a meaningful effect early next year. So we're hopeful that that will take some of the heat out and concern out of that side of the equation. But I think a number of our developer clients are pausing some schemes because they just can't make them work right now, or are,
but if we are heading for the R word, if we are seeing an economy shrinking, that's going to have a massive effect on sentiment. And what effect's it going to have on the sentiment of investors and lenders?
I think inevitably it's going to bring a bit more caution to the lending community. I wouldn't believe anybody that said they wouldn't. But that said, having been through cycles before with the bank, when markets become fractured, it also brings opportunity, and it's how the property sector evolves and adapts and goes again. So I don't think it's all doom and gloom. I think there will be opportunity coming out of it. I don't think there's anywhere near as much latent distress in the system as there was anything like GFC. So I don't think we're going to see a crash in any sense. My personal view is that it's probably a more measured sort of heat out of the housing market in particular, which I don't necessarily think is a bad thing at the moment. I think to do with
that's certainly true. Ben, where I mean, we saw Lawrence's graphs yesterday morning, and actually there's a lot of sentiment that says we're going to see things get really difficult. Actually, things will start settling down perhaps in a couple of years' time. So it's just something we have to get through. Yeah,
it's an unusual, to say the least, an unusual situation that we've not experienced for 30 or 40 years at the least. We all know the numbers. The challenge from a real estate investment point of view is if you're a leveraged investor either in development or existing stock, it's very difficult at current pricing to make deals work. So a levered investor, it's almost impossible, depending on which part of the market you're in. If you're an equity investor, it's a bit more straightforward, but if you compound the rise in the cost of borrowing on top of the uncertainty about construction costs, it makes it a very difficult environment to invest. What the challenge is for investors is to see through the valley, a phrase I used earlier, but see through the valley in terms of can you deliver something 2 years hence when conditions are almost certainly going to be significantly better. And stepping back as well from a housing point of view, particularly in a rental housing point of view, the shortage of product, as we've heard in many times, those demographic issues, those issues of household formation, the issue of demand for the product that you've heard many people talk about on this stage, they won't go away. And so if you can provide the right product 2 years hence, there will be demand and the rental conditions and the supply demand look quite good. But it's getting through these next 18 to 24 months, which is where equity investors have an advantage over levered investors, and where lenders have got a real challenge for sure, and our lending business is really challenged too. But it's unusual and difficult for sure.
Shamez, a question that's come in on swap card. What does the panel think will happen to rental and capital values in the coming 1 to 2 years, given the economic challenges?
I think we are at the beginning of a very substantial regime change, right? We've had 30 years, to your point, of just inflation trending one way, right? Long-term rates trended one way. The phase we're entering now is one of higher volatility of inflation. Inflation will be much more pervasive, and it'll ebb and flow. We've seen that in the 60s. So if you go back to the 60s and you look at inflation, and what did rates do? Average rates were higher. From our perspective as an investor, that means that where assets priced a year ago, you have to be 20% wider. From an investment perspective. Yeah. Because the average long-term base rate should be about a point higher. On a 3.25, 3.5 yield, that's about 20% loss in value. And I agree with Jason that that's not a distressed event that happens tomorrow. That's a grind. That's people slowly realizing that yields are not coming back to that 1%, 0%, 0.5% that Jason used to lend money to us at. He's going to be much more frugal in the next 5 years out. What does it mean for capital values for housing stock? I think we have a real situation here where housing supply will continue to be limited. Planning is still reducing the amount of housing stock. So there will be a natural supply-demand correction. There will be a reduction in demand because people can't afford it, but there will be a natural correction in supply because we just don't build enough houses. And then that takes you to the rental market. And I think we are going through the transformation. I think the idea of single-family rental, the idea of families moving into a community outside of London, in Birkenhead or wherever, and living in a rental home will be much more common because they'll just.
Do you think it will happen? Traditionally that's not what we do, so it's going to require a change in sentiment, isn't it?
I think it's a change in economics.
Yeah,
it's just a pure and simple change in economics. That, given how quickly house prices have appreciated, it's the first time I think in the UK's history where house prices are 9 times earnings. Right? Yeah. In a higher interest rate environment context, it's going to be much more difficult for people to get onto that housing ladder.
And it's also interesting the evolution of different models kind of in the middle, where there's the rent-to-buy type in various forms, where it kind of buys people that period of time in which to build up the capital base they need to actually go buy again. So there's.
I mean, it's interesting that point about 9.1 times annual earnings, average annual earnings now for the average house in England. And that is phenomenal. In some parts of the country, it's 2-3 times that. So, clearly there's a massive unaffordability issue. But I remember, when Brexit was being debated, during the financial crash, before that, during COVID, there were lots of people saying, actually, do you know what's going to happen? House prices, it's all a bubble. It's all going to start falling away. And then it didn't happen. But your analysis implies that you don't think it'll ever happen, because is it not impossible that we could actually just see that particular bubble burst, reality arrive, and we see house prices falling?
I think the banks have been very disciplined, right? The Bank of England, working with the banks, has made sure that the banking balance sheets are healthy. Yeah. There's no forced foreclosures. People came in on average interest rates of 1.5% fixed. over the last 5-6 years. So I'm less concerned about a crash in capital values of, the value of my house or somebody else's house. What I think will be tougher is that grind will be slower. Right. I think, look, there's a new stamp duty cut apparently that's coming.
Yes, well, we don't know
in a couple of hours.
But the Times seems to think that's really going to change the game. No.
Yeah. But I think in the long term, you can't escape gravity forever, right? So I think it will be a slow grind, but not a crash.
Yeah.
And just on that point, the biggest difference between that argument, the Brexit argument, was the debt service costs. Yeah. So the argument was, well, it's very unaffordable based on income, but debt service costs mean it's easy to service based on income because interest rates are so low. As you said, interest rates are not low anymore and are not likely to stay low, so servicing those debts is harder as well as the absolute values, and that's the difference. Yeah.
There was a question there. What does the panel think? Well, I've done that one. What's the decision process in investing between the likes of Barratt, reporting £1 billion pre-tax profit today, versus the likes of Goscombe? Did you see that presentation earlier? I know it's really, it's quite inspiring hearing people talk about purpose and profit and which comes, top of their list. Does the investment community take a kind of hard-headed think? We want somebody who really cares about the bottom line, or are you thinking, actually, we want people who are thinking about making the world a better place? Because that's. Oh, you're all, yeah, okay. Well, let's see how we go with this one. Well, you could start. We'll go around.
Well, as a lender to Barratt, I've got to be careful how I... but equally, I was too very impressed by the Goscombe presentation, and I think the way in which we think about supporting businesses like that is through, we have pockets of capital that we phrase unreasonable impact, where our actual motivation is more with a societal good view. It's not necessarily, we're going to make a whole lot of money out of this. It's not so much a commercial decision. Yeah. So we think about those two ends of the spectrum in very different ways, but we'd like to support both.
Well, I guess, Ben, this goes back to investors wanting ESG to be absolutely up there, doesn't it?
Yeah, and I think it's really important to distinguish between strategies in the investment world that are impact strategies versus strategies like the ones we run predominantly, which are ESG integrated investment strategies. A subtle but important difference in that impact investing has a social purpose at the very heart of it, and a secondary purpose is the return. As I was saying earlier, our perspective on this is we can solve a whole host of social and economic problems in the UK, and investing in housing is one way of doing that, and affordable and social housing is a massive part of that, but also generate an appropriate return for the risk you're taking, and that's important, my job as a fiduciary. I come back to what I said earlier, that integrating ESG risks into my decision-making process, into our investment committees, is a really important way of delivering better risk-adjusted returns. Those investors who price social risks, carbon risks, net zero risks around their investments will outperform. So that's what we're trying to do, which is a subtly different thing than having impact as the purpose itself. A subtly different point.
Shamez, how do you, in your thinking, deal with, it's a good question, about a company that's obviously doing very successful on the profit front versus a company which is actually very upfront about saying social purpose, social value is more important to us, or as important to us as our bottom line?
Yeah, look, the house building sector is a lot to answer for, right? So, I don't know, I'm trying to measure my words carefully. You want to see the Gascombe succeed, right? Because you want them to change the narrative. Right? An established house builder is not very incentivized to go up to his shareholders and say, well, we'd like to take a risk on our £1 billion of profit and try this new idea, right? It's not going to happen. The way it's going to happen is Gascombe does a fantastic job and people emulate and copy. So our capital, we work with house builders. When we engage with house builders, we're trying to nudge them forward. We're trying to say, guys, you can do a lot better. You can do this. How about we do it this way? How about we do it that way? And you're trying to bring them slowly with you. And I think that's an important pull factor.
Are you doing that because you want to make the world a better place, which is no bad thing, or are you doing it because, in a sense, you're future-proofing yourselves? Because if you get the underpinning, the social underpinning right, actually, it's going to make things safer.
So, Look, as an impact investor, I think these are false dichotomies. We're always choose saving the planet or making lots of money. Which would you like? Well, I've got a 6-year-old daughter. That's an easy choice for me, right? So I think it is a false choice. Right. I think when you start to think about returns over a long term, what Ben is talking about, as institutional investors, we're thinking 10, 15 years out for what our capital is doing. In that context, it's exactly the same thing. So I can pull Barrett's along and say, guys, I'll buy this asset from you at this price because it's not going to be a stranded asset in 10 years or in 5 years. And I can push Gascom along and say, guys, here's 50 million, go out, buy lots of land and just make a difference. So I think both strategies, you have to look at both things in your investment strategy, and you would do the same, right? I'm
interested to know to what extent the thinking differs in different geographies. I mean, is the way that people think about investing in the United States, for instance, different in terms of that balance between ESG and the bottom line than it is in Europe?
I think Europe's far ahead of the US when it comes to ESG. Really? In general.
Yeah, that's interesting.
So I guess in the US, it's for the last 10, 15 years, rental inflation has been super high. So take Phoenix, for example, that's had 30% rental growth year on year for 3 years. It's insane. The space over here, the real estate is fundamentally different. Our use of fuel and energy. So our investment thesis is, the US is very lick and stick. I was very surprised by the level of service we have in the US is phenomenal, but the real estate is very different. I'd say we're 10, 20 years ahead of the US when it comes to sustainable credentials in our buildings, especially new buildings.
What does the legislation time frame look like in the States? Is it very different from here in terms of where people are supposed to get to? Yes.
Yes. That's a very, very deep and complex topic.
And it's much more driven state by state. Yeah. Right. It's not driven at a federal level at all.
Right.
New York State and New York City has got very different rules, and California got very different rules of engagement than you might find, in some of the Midwest states. So it's state issues.
All right. We've got some quite good questions. We've got 3 minutes left, so we'll just rattle through some of the ones that have come in. Would you back an Elon Musk type who wants to do a Tesla, i.e. launch a disruptor development/investment business from a clean sheet? Would you?
I think they exist, frankly.
Yeah.
I think.
Or maybe Shamez, you're almost in that space.
I think they exist, and I think what's interesting about the discussions we've had today and yesterday in this space is that the BTR space, the private rented space, has just become a massive part of the resi world. This conference a few years ago would have been all about private for sale housing. That's all it would have been about. So you've got these disruptive. So think of that panel here on service providers, for example. A whole bunch of disruptors there who didn't exist. Their business didn't exist a few years ago. So it's happening.
Yeah. Fine. What do you think will be the impact of the potential stamp duty cuts, which may be announced on Friday? Well, we don't know where they're going to be announced. We have, of course, been here before, so we can have a pretty good idea of what the effect's going to be. What do you think it's going to be, Jason? Is it going to solve the housing crisis?
I'm afraid not. I mean, it may help, to your point about easing the pace of the grind or the feeling of the grind. But I think it won't have the same impact that we saw through COVID, where it literally was a spark in terms of the housing market. But also
demand side intervention of that kind doesn't really deal with the actual problem.
The problem, absolutely.
Okay, that's a good answer to that. Reason for high level of rent growth seen in LTM plus sustainability of growth. Under supply story is clear, but not a new phenomenon, while affordability remains strained. I mean, yes, we agree. That's fine. We'll just nod at that one. Are the private debt markets as gloomy as the headlines suggest? What does this mean for investment in the sector? Who wants to pick that up?
Do you want me to start?
Yeah, go on.
They're pretty difficult at the moment. So we have a number of our clients who would typically access the bond markets, every 1 or 2 years. They're now coming to the banks seeking increased levels of traditional banking facilities to kind of see it through. And, we've seen this before. It happens in cycles because that market will come back and then the banks will come down on their revolvers and so on. So I think this is just a temporary phenomenon, but they're definitely choppy.
Okay. I mean, just a point on the private debt market, us as an insurance business that lends against commercial real estate and resi real estate, we like this moving out in interest rates because, you know, the risk-adjusted returns to lending against existing stock are really attractive. So we've got appetite from a private debt business, not development, but for existing stock.
So, I mean, we've touched on this, but I'll just ask you as the final thought. What's the driver behind the recent boom in rental growth, given that the undersupply argument's been around for years? Shamez.
So I think it just is, you know, you've had residential really outperform a lot of parts of the real estate space, right? They outperformed office, they outperformed, you know, retail, et cetera. I think people are looking for a stable asset class. And, you know, if you create a good product, it's Maslow's triangle. People always need a place to stay. So I think that's been the attraction, the realization from investors that this is actually done well, done properly. It's a good investment class.
Given that we're in such an extraordinary hiatus at the moment, sort of politically and legislatively and all the rest of it, it's been fascinating to hear what's in your heads at the moment. It's been really, really helpful to get a handle on all of that. So our panel, ladies and gentlemen, thank you very much indeed to the money.